Hello, my name is Doug Greenberg, and I'm the president of Pinnacle Wealth Advisory. Thank you for tuning in to this month's 3 Slides in 3 Minutes. This chart provides a clear picture of the performance of larger companies compared to the smaller ones within the S&P 500 from 1990 until July of 2024. The blue line represents the ratio of the S&P 500 market cap weighted index to the S&P 500 equal weight index. When this ratio is above 1, larger companies are outperforming their smaller counterparts. And when it's below 1, the opposite is true. The shaded bands indicate different standard deviations around the trend line, showcasing the ratio's historical volatility and range. The green line marks the long-term trend of the ratio. In recent years, driven by AI narratives, U.S. stocks and the S&P 500 have seen increasing valuation, raising concerns about potential bubbles. Since the COVID-19 pandemic, the ratio has steadily risen, reflecting the dominance of larger companies. While the ratio stayed around +1 standard deviation from 2020 to mid-2023, it began to climb significantly, surpassing 2 standard deviations in June of 2024. This indicates that larger companies, particularly in AI-influenced sectors, are outpacing smaller ones, hinting at a possible overvaluation. However, the ratio still has some growth room compared to the dot-com bubble period in 2000 and 2001, where it exceeded 3 standard deviations before crashing. Overall, the chart suggests signs of a potential bubble, but it has not yet reached the extreme levels of the dot-com era. This chart presents the trends in U.S. core consumer price index inflation rates from 2021 to the present using 3 measures. Year over year, it's the purple line, month over month, annualized, the green columns, and instantaneous, which is the blue line, which weighs more recent observations more heavily. Understanding inflation is vital for monetary policy, particularly for the Federal Reserve. Traditional inflation measures show yearly and monthly trends, but these can be skewed by outdated data and short-term fluctuations. Instantaneous inflation offers a balanced view by considering immediate price changes without the noise of the short-term data. In 2023, instantaneous core CPI inflation in the US was lower than annual changes, suggesting a moderation driven by lower monthly changes. However, in 2024, the surge in the instantaneous core inflation above the annual rate indicated a more persistent inflation risks. Most recently, the softening of monthly underlying prices, including the May-June 2024 CPI reports falling short of expectations, has brought the instantaneous core CPI inflation below the yearly rate again. This trend supports the increasing likelihood of the Fed considering rate cuts, especially in their upcoming 2024 meeting. I personally would find it interesting if the Fed made a cut prior to the election, as the Fed wants to not be a political governing decision-making body. Small cap companies have a higher share of floating rate debt, with roughly 51% of the companies in the Russell 2000 compared to 25% in the S&P 500. This means small cap companies are more vulnerable to Fed Reserve rate hikes and higher rates over extended periods. Despite the Fed turning dovish in December of 23, with rates coming down and credit spreads tightening, small cap earnings have shown no signs of rebounding, as illustrated in the second chart. This situation underscores the extreme concentration in the stock market, where small cap earnings expectations remain weak, even in a strong economy with declining yield levels. The likely reason for this is that 41% of the companies in the Russell 2000 have negative earnings, indicating poor credit fundamentals, as shown in the third chart. If we achieve a soft landing with inflation decreasing and the Fed cutting rates, earnings expectations should rise for both small cap and large cap stocks. However, this is not what we are currently observing. On another note, small cap stocks that have performed well eventually grow to be mid-sized companies and large-sized companies, leaving behind the companies that are not growing their earnings or have negative earnings. So you end up with a different makeup of the Russell 2000 today than you might have had 10 years ago. Thank you for taking the time to watch. And if you have any questions, please let me know. Thank you.